Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe. We're going to continue to look at the CXC Principles of Accounts January 2024 response with a focus on question 4. Yes, we're at question 4, where candidates were tested on private limited company, capital and revenue expenditure, and depreciation. Before we start working, if you have missed questions 1, 2, and 3, the links are in the description below. Let's get into the question. And it reads, Jasper Poppy is the owner of Bella Cutie Limited, a private limited company. State 3 features of a private limited company. Now, private limited companies are companies that are owned and operated by private shareholders. And we're talking about family and friends. Shares are not openly traded on a stock exchange, and shares can only be bought and transferred with the permission of the board of directors. And any other appropriate response will do for this section. Let's move into the other part of the question, which reads, Bella Cutie Limited purchased new premises on December 1st, 2023. The following provides details of the amount which was debited to the premises account on December 1st, 2023. And we're presented with a list of details relating to the premises for that period. And we are asked to calculate the amount which should have been debited to the premises account on December 1st, 2023 for the purchase of the new premises. Now, in order for us to carry out that task, we have to review the concept of capital and revenue expenditure, where capital expenditure is when a business spends money to buy or add value to a non-current asset, which includes any cost needed to get the non-current asset ready for use. So we're talking about like the purchase, the cost we use to purchase it. If there's any legal fees attached to purchasing the fixed asset, which is a non-current asset. If it is that there is any cost that is spent to expand the fixed asset at that time, probably there's a need to install additional fixtures, etc., in order to get that non-current asset ready for use. All of that cost would be considered capital expenditure. Whilst for revenue expenditure, these are expenses needed for the day-to-day running of the business. So for example, if there's any insurance that is to be paid on the non-current asset, then that is a revenue expenditure. If there are rental costs, then that is it's also a revenue expenditure. And there are others. So now that we have reviewed capital and revenue expenditure, let's get back to responding to the question. And in order for us to do that, we're going to look at each detail to determine what we're going to use to calculate the amount that should be debited to the premises account. And remember, we're looking only for capital expenditure. And we begin with the first one, which is cost of purchase of premises. And that is 119,200. Definitely, that is a capital expenditure because that's a purchase of a fixed asset. And that will be included in our calculation for the capital expenditure. And we can proceed to start even doing our preparation of that calculation. So we are going to enter just a little title here, capital expenditure for premises. And we're entering the first item, which is the cost of premises, and that is 119,200. We're going back to the question to pick up additional details, and we move into the second item, which is legal fees incurred for the purchase of the property. This included $300 legal fees paid for recovery of a bad debt. Now, what information from this will be capital expenditure? Because yes, we have capital expenditure there. We have a legal cost that was incurred to purchase a property, and that is capital expenditure. But there's a $300. This $300 that was paid for legal fees for recovery of bad debt. That will not be a part of the capital expenditure. This will be revenue expenditure. It is not a part of the cost that is incurred by the business in order to purchase that fixed asset, to get that fixed asset ready for its intended use. It is not a capital expenditure. So it therefore means that we need to take out that $300. So it is a 10,800 minus 300, which gives us 10,500. And it's a 10,500 that we're going to use for our capital expenditure. Let's enter that in our workings. And that is the cost of premises. That was the first one. And now we're adding legal fees to purchase the property. And remember, it is only 10,500 that we are calculating. We're including in our calculation for the capital expenditure because the 300 is not associated with getting the premises ready for its intended use. And we are going right back to the question to gather more details for our workings. Now we have installation of upgraded water pipelines on the premises. Is that a capital expenditure? Yes, it is, because we need that in order to get the premises ready for its intended use. So we're going to add this to our workings for the capital expenditure, the cost that the business should debit to the premises account. So that is the installation of pipelines, and that is 5,600. So we're going back to the question to see if we have anything else in terms of details that is considered, that is capital expenditure. And the next item is redecoration costs. And it's saying that half of which is payment made in advance for redecoration work to be performed in January 2024. Now, the total value for redecoration cost is 11,000. But do we use all of this? Because a part of it, yes, is definitely capital expenditure, because you're redecorating the premises for its intended use. So we want to get it ready for the purpose of which it was purchased for. So the redecoration cost is capital expenditure. However, not all of it is capital expenditure. Why? Because there is an advance payment that is made for redecoration work that will be done after the premises is set up for its intended use. So therefore, that amount, that extra that is paid, will now be considered as revenue expenditure. And that is for in January 2024. So we're going to calculate the amount that is needed, which is a part of our capital expenditure cost. And that is 11,000 divided by 2. And that gives us 5,500. So we're going to add that to our workings. And again, that is redecoration or costs, and that is 5,500. Going back to our details to see if we have anything else that relates to our capital expenditure as it relates to the premises. And we move into labor costs to extend the office area. Is this capital expenditure? Yes, it is, because we're expanding that area for the office space. We're getting the premises ready for its intended use. So therefore, that is capital expenditure. So we're going to include that in our workings, and that is labor costs to extend the office, 16,000. And we're going back to see if we have anything else. The next item is insurance paid for the premises, the new premises, and that is for 12 months. And the insurance that is paid is not a capital expenditure. It is considered as revenue expenditure. So we have extracted all the details that we need for the calculation. So now we're going to total, and that gives us a total of $156,800 for the cost that should be debited to the premises account for the month of December. That is a capital expenditure for that period. Let's move into the next part of the question. And this question requires that we calculate the total amount to be charged as expense to the income statement for the month of December 2023. And basically what we're asked to do is to calculate the value of the revenue expenditure. So we have to go back to the question to get that done. And from the question, if you recall, this $300 for legal fees paid for recovery of a bad debt, which was not considered as capital expenditure, that is now recorded as revenue expenditure. So let's put that in our workings. And our title is expenses for the month ending December 31st, 2023. So basically, remember, we're extracting details relating to December 31st, 2023. And the first item that we have extracted is the legal fees for bad debt recovery, and that is $300. Let's get back to the question to see what else we have. Now, if you recall, the half of the redecoration cost that was paid in advance, it does not relate to this period. Yes, we would have used the other half for capital expenditure, and there is half that is still left. But that half, that extra half, is related to January 2024. In fact, if it is that the cost was related to redecoration for the month of December, then all of that would have been recorded as capital expenditure. So the amount that is the other half that is left, it is for January 2024, and we're doing the revenue expenditure for December 2023. We're not going to use that. But the other thing that is left in the list of details is the insurance paid for the new premises for 12 months. And that begins from December 1st, 2023 to December 30th, 2024. Yes, that is revenue expenditure, but not all of it will be used in this month. We're only extracting for 1 month because we're looking at December 2023. So what we're going to do is to divide that 12,900, which is the full cost, by 12 to get the amount that we're going to record as revenue expenditure. So in our workings, the premises insurance, 12,900, because that is the full cost for 1 year, remember, and we're only showing for 1 month. So we're dividing this by 12, which gives us a value of $1,075. And there's no other details. So it therefore means that we're just going to total, and our total revenue expenditure, which is the expense for the month of December, is $1,375. And we're now going to move into the other part of the question. On January 1st, 2022, Bella Cutie Limited had purchased a heavy-duty machine costing $186,000 on credit from Chingsing Limited. The machine depreciates at the rate of 40% per year, 40% per annum, using the reducing balance method. Calculate the depreciation expense for each of the following year ends. So just to point out to you that the depreciation rate is 40% per year, and the cost for the one is $186,000, and the business used the reducing balance method. That information is important to us. So the first year, which ends December 31st, 2022, is the period in which the machine was purchased. And in order for us to calculate depreciation in the first year, it is the cost multiplied by the rate. So we're simply going to pick up the cost price of $186,000, and we're going to multiply that by the rate of 40%. And that gives us a depreciation of $74,400. So what this is saying is that so far, at the end of the first year, the machine has lost $74,400. And in the second year, remember, we're using the reducing balance method. So in the second year, we're calculating the depreciation on the current value of the fixed asset, that non-current asset, which is the machine. And in order for us to calculate that, we're going to simply pick up the cost minus the previous depreciation, and then that will give us the value of the fixed asset after it was depreciated for the first year. And then we're going to multiply that by the rate. So in order for us to do that calculation, pick up the cost of $186,000 minus the previous depreciation, which was calculated in the first year, which was $74,400. And then what we get, we multiply that by 40%, which gives us a depreciated value, the depreciation cost for this year, which is the second year of use, of $44,640. And remember, we're using the reducing balance method. So once you're using the reducing balance method, you pick up the cost in the first year, multiplied by the rate. Now, when you move on to the other year, it is cost minus the previous depreciation, which is the total at which the asset would have been depreciated by so far. And then you multiply by the rate. So that is what we did for the second year. So that part of the question is done. All right. So let's move into the other part. And that requires that we complete the extract below to show how machinery would appear in Bell Equity Limited statement of financial position as at 31st of December 2023. And of course, that's asking us for a balance sheet extract, and it is related to that non-current asset for the second year, at the end of the second year. So basically, I want to see how you would have applied your concept in preparing the balance sheet for that section relating to the machinery. And definitely we need our title, which is Bella Equity Limited Statement of Financial Position Extract, because we're not doing the full thing, and it is as at 31st of December 2023. And we're focusing on machinery. And machinery is from the family of non-current asset. It is a non-current asset. So we need to show that title, that machinery is from that category. And we're going to enter that, non-current assets, and we're focusing on the machinery. So we have to show that we're looking at the machinery. So our details there is machinery. And the first thing that we're going to pick up is the cost, then the accumulated depreciation, and then we're going to calculate the net book value. But remember, we're looking at the second year. So let's go back to the question to pick up the cost price for the machinery. And remember, the machinery costs Bell Equity $186,000. And that is what we are going to enter as our cost price in our workings. In the balance sheet, extract that statement of financial position, extract. So under the column costs, we're going to enter $186,000. Then we're going to pick up the accumulated depreciation. So we have to go back to the question to determine that, because remember, accumulated depreciation is the total depreciation to date. It's asking us to show how much the fixed asset, that non-current asset, has depreciated for from the time of purchase to now. And it has been purchased for 2 years. So we have to total the depreciation for the first year and the second year to get accumulated depreciation. The first year was $74,400 as the depreciation. So again, that is $74,400. And the second year, it is $44,640. We're going to add those two figures together to give us accumulated depreciation of $119,040. So remember, accumulated depreciation is total depreciation to date, and that machine was purchased for 2 years. It has been in the business for 2 years. So we're looking at depreciation for the first year and depreciation for the second year to give us our total depreciation. Now that we have calculated that, we're going to enter that in our balance sheet extract. So it is $119,040. And now we're tasked to calculate what is the net book value. How do we calculate net book value? Net book value is simply the cost minus accumulated depreciation. So we're going to subtract the 119,040 from the cost price of $186,000 to give us a net book value of $66,960. So what this is saying is that the machinery is now valued at $66,960, having depreciated, having lost some value of $119,040. And now we are going to move into the final part of the question, which requires that we state two factors which cause non-current assets to depreciate. It's asking you, what are the causes of depreciation? And it's said to state, so we're not expecting that you're going to list and move and dance your merry way to the next question. State, list, and give brief details. So let's move into one such example, and that is technological change. And for example, machinery like computers may quickly become outdated and thus unfit for the purpose of the company that owns it. So basically saying that because of the advancement in technology, then the non-current asset that the business has may not fit for the purpose, for the use, what the business needs to use it for. So therefore, it has depreciated. Another reason, another cause of depreciation is inadequacy. And basically, you find that where the business is growing, the non-current asset that it has may not be able to carry out the task, the volume of tasks that it would need it for. So therefore, it would have lost its value. It would have been depreciated. So inadequacy, it states that as a business expands, certain non-current assets may become insufficient and consequently lose their value to the company. Another is wear and tear, and you could expand on that. And we have erosion, rust, rot, decay, we have depletion, etc. So those are some causes of depreciation. And that takes us to the end of question 4, where candidates were tested on private limited company, capital and revenue expenditure, and depreciation. And again, if you have missed questions 1, 2, and 3, the links are in the description below. See you soon, where we will look at the final question, and that will take us to the end of the response for January 2024 paper. Like, share, and don't forget to subscribe.